Hey guys, welcome back to the channel. Year after year, we see articles saying that British stocks are cheap and now is the time to buy.
I solemnly swear that British stocks are good.
And an unwitting few, including myself, have fallen for the trap of then going on to buy FTSE 100 ETFs and crying and being shocked when the performance is terrible.
Please.
I've been a huge critic of British stocks in the past, with most British companies being in sectors that don't provide that much value for investors, having very high dividend payout ratios, unsustainably so, and also having low profitability metrics whilst also growing at slow rates as well. But there is a reason to take a look at British companies once again, as the British ISA has been announced by Jeremy Hunt, an additional £5,000 ISA allowance tax-free for investors to invest, but only into British stocks. Today I want to do a stock analysis on one British company that I'm considering adding to my British ISA allowance, or even putting into my normal ISA before that gets announced. And that company is Rightmove. Before we get into the stock analysis, let's talk about why we should consider investing into individual British stocks rather than investing into the FTSE 100 or the FTSE 250 via an ETF. Now, traditionally, the advice for investors is that investing into ETFs provides a safer and more effective way of investing. After all, 90% of fund managers can't beat the S&P 500, so why should you bother? You might as well just own the basket, because you can't pick the stocks that are going to win in the long run. I do have some reservations with this advice, but for the vast majority of investors, I think it's pretty sound advice. And if you think about it, if you have a basket of companies in the S&P 500, you have all of the best companies in the world in that basket, some average ones and a couple of poor ones, which means the overall average return is going to be pretty great. But the real issue comes when you take a basket full of UK companies. The vast majority of them are pretty crap, which means you have a basket full of crap and a couple of diamonds. And the average of that is probably going to be crap. And you can see that when you compare the total returns of the FTSE 100 versus the S&P 500 over the last 5 years. The S&P 500 has returned nearly 15% per year, whereas the FTSE 100 has returned just under 6%. With those kind of returns, you might as well just bin the British ISA, invest in the S&P 500 outside of the ISA system, pay the tax on it, and you'd be better off than had you bought the FTSE 100 inside of the ISA. So I personally think that when it comes to British stocks, it's even more important to be picking those diamonds out of the basket rather than buying the basket itself. So how do we know what's a diamond and what isn't? Well, to start with, I like to look at the story of a company. What industry is it in? What's its market share? Is it threatened by any competitors? How has it grown to where it is today? And is there a runway for growth in the future? Equally important is the financial record of a company. Is it historically good at growing its revenue? Is it good at allocating its capital? Is it capital light? Does it return profit to shareholders in a sustainable way? And so on. So to start with, let's look at the story of Rightmove. Rightmove is the UK's largest online property portal, where people can visit the website in order to find properties to rent or to buy, and it makes money by charging real estate agents to advertise properties on their site. Now, it has a crazy 83% market share and is effectively a monopoly in the UK. Because it has such a large market share, it doesn't really make sense for real estate agents to list their properties on other sites when the vast majority of views are going to be on Rightmove. That means more properties end up getting listed on Rightmove, and it drives a positive flywheel where people are more likely to come to Rightmove and not go to its competitors, which means that more real estate agencies are going to spend more money on their site. Because of the fact it's a monopoly, it means it can effectively set the price at which real estate agents have to pay their fees. They can't really debate with Rightmove, because if you can't use its site, then you're not going to get any sales. So Rightmove effectively dominates the market here. Whatever you might think of the ethics of this, it's undeniable that investing into a software or website monopoly is a fantastic investment. Just look at the property market over the last few years, which Rightmove obviously inherently derives much of its value from. House builders have had declining revenue over the last few years as house prices have been very volatile following inflation and interest rate increases. Just look at Persimmon, whose revenue is all over the place for the last 5 years. But when you look at Rightmove, it steadily increased its revenues despite declining visitor traffic on its site. Those declines aren't because it's losing market share to its competitors, it's because the housing market as a whole has slowed significantly as interest rates are at the highest they've been in 20 years and people aren't as interested in moving houses at the moment. The fact that Rightmove has managed to grow its revenue by nearly 10% by increasing its fees to agents in this kind of a market is outstandingly impressive. And when interest rates come down again, I'm sure that those numbers are going to spike even higher and the revenue will also increase again by even higher. One of the best aspects about investing into technology or specifically internet companies is that they're extremely scalable and capital light at the same time. If you were to list 10 houses on Rightmove, it costs them about the same amount of cash as were you to list 100 houses on their site or even 1,000. That means any new listings on their site or new users are almost entirely pure profit for them, which makes the company extremely profitable. Their profit margin stood at 71% in 2023, which is outstanding for even a Silicon Valley tech company. When companies spend money, it's usually done as an investment in order to get more money back. And you can effectively calculate how efficient a company is at spending its money with the ROIC statistic, which is return on invested capital. For most tech companies, this is very high. For example, for Meta, it's 26%, which means that for every $1 it spends on investments, it gets $1.26 in return. But when you look at Rightmove, this is an absolutely crazy statistic. It's 400%, which means that for every £1 that Rightmove spends, it gets £4 back in return. I had to check this to make sure that I wasn't looking at some kind of a bug. Rightmove also deploys its capital efficiently when it comes to shareholder returns. The company has a dividend of around 1.5%, but also buys back a significant amount of its shares, which I really like to see. Over the last couple of years, Rightmove has had a decline in share price and the company has upped its share buybacks as a response to this, which is a fantastic move in my opinion from their board. Overall, the total return to shareholders is around 4 to 5% per year in recent years just from buybacks and the dividend, which is fantastic to see. This cash return to shareholders is also extremely stable in my opinion compared to many other UK companies that boost their dividends in order to try and attract investors, but unsustainably so. The company only pays out around 35% of its entire earnings in the form of dividends and share buybacks to its shareholders. So that is definitely sustainable in the long term, and it's exactly what you like to see in a company. Rightmove is also debt-free. So with all of these amazing qualities, you would be thinking, well, Rightmove must be trading at an absolutely insane price to earnings ratio, right? Because the growth is high, the profitability is high, it's a monopoly, it's returning cash to shareholders, and so on. Well, in fact, no. Rightmove is trading at historically low levels at only around 21 price to earnings ratio. If this was a US company, I bet it would be trading at least 30 or 35 price to earnings because of its high quality nature and the monopolistic way that it operates. Now, you're probably thinking, well, if the company is trading at only a 21 price to earnings ratio and has all of these crazy positive aspects, then there must be some negative news weighing on the company. And yes, you would be right. There are a couple of factors that have led to the company's share price going down or staying stable over the last couple of years and having the price to earnings ratio lower as a result of that. Those two factors, one of them being the slowdown in the housing market in general. Because of the slowdown in the housing market, it's led to declining traffic on the website. Rightmove has warned that 2024 might see more of the same with less traffic and less users browsing their site, but also projected a 7 to 9% increase in revenue in spite of that. So it's not too big of a worry in my opinion. When the housing market picks up again, I think that the company will do amazingly. And it's not like the housing downturn is going to go on for the rest of human history. Eventually, it will pick back up and we'll see traffic start to increase again. One of the other factors behind the market's nerves with Rightmove is increased competition. One of its main rivals on the market was bought by the US property market, CoStar. CoStar is much larger than Rightmove because it's in the US market. We've seen this story time and time again. A US company swoops in on a European market, takes over with its huge pools of cash that can't be competed with by any local competition. And people are worried that it will happen again here with Rightmove. But the whole reason that On the Market was sold in the first place was that it failed to disrupt Rightmove or take any market share from it. And another competitor in the market, Zoopla, is already owned by a US equity group and has also failed to dislodge Rightmove. So I don't think that this natural monopoly that they have is really under threat. And I think the market is overreacting, which means that I think Rightmove's share price right now is a bargain. And I am seriously considering buying some soon. One of my main annoyances with British companies is that they only report their earnings annually, whereas US companies report their earnings 4 times a year. That means you have 4 opportunities to see if anything has drastically gone wrong in a company's story and potentially decide whether to buy more or sell out of the company. I'll be paying attention to Rightmove regardless as much as what is possible. What do you guys think about Rightmove as a stock? What companies are you thinking of putting into your British ISA allowance? And there's also been some recent talk that ISAs could potentially be banned. So please watch my video here if you want any information on that. Leave me a like and subscribe if you enjoyed the video, and I'll see you guys next time.